I can go extra mile and be giving you uh, the question that was supposed to be tested under strategy financial management. They can dash you for financial management. And then that's why when you are preparing for ICANN, don't limit yourself to kind of question you can see under financial management. However, wherever examiner is coming, you should be ready to tackle it. All right. So like I've been telling you in the past, since we started these diets, all what we are discussing, for example, under cost of capital is the same thing I do in strategic financial management. But at that level, the kind of the expectation of the examiner is different from under financial management at your own level. So you have to go all out when you get to a professional level under strategic financial management. However, ordinarily, is only one question I have in mind before to solve with you. But one of you was asking me about a few days ago or thereabout. I think that was it Omotayo was asking me that, please, are you going to solve the question tested last diet? Okay, I said no. I said don't worry when we get there. In November diet, when I can started the new syllabus, you know, one question was tested under cost of capital, which was project specific cost of capital. And the last diet also, question number 2 was on cost of capital, which was a traditional weighted average cost of capital. All right. So my mind was not even there before. I've forgotten that it was tested. Not until Omotayo was telling me that if I'm going to solve it. But that notwithstanding, at the end of today, before today runs out, we'll solve it together. All right. But we have to go through this question together. So there are some peculiarity there and something we have done in the past when I was explaining the concept. Therefore, we need to put it into practice so that however the examiner is coming out to you, you should be able to do justice to it. In addition to this, some of you are still struggling with cost of capital, and I'm not happy with that. I'm not happy with that. Uh, I gave assignment to you guys. I gave a classwork. I also gave an assignment, but your solution, your answer to those uh, assignment and classwork is very discouraging. I don't expect that you will be having such a solution to question, which is not acceptable. You can do better than that. These are very simple questions that you are supposed within 2 minutes it should be done and move on. But some of you are still struggling. Some of you are using the old method you are familiar with, and you don't want to change that, and that is affecting you. That's affecting you. Some of you are changing, you are using different formula from the one I gave to you in the class, which is acceptable, because there is no one way of solving a question, of solving a problem. There are different ways you can do it, but whatever the method that you want to adopt, do it and do it very well. Some of you, I gave you a formula for calculating cost of equity as where there's growth as current dividend multiplied by 1 plus the growth rate over X dividend share price plus the growth rate, all multiplied by 100%. Some of you are using D1 over P then plus G multiplied by 100%. There's nothing wrong with that. If you do that, that means you are going to be having 2 different steps. You need to first of all multiply the current dividend with the 1 plus growth rate before you can then say D1 over S dividend share price. So all of these things, you have to find a way of doing things in a new, different ways. Don't be archaic, just following one direction, And even with that, with the D1 over PO plus G that you are using, which is also acceptable, you are making mistakes. You have to avoid all of this. You have to, that's what I told you, zero your mind, just believe and you don't know anything about it. Start afresh. That's the way to learn. By the time you understand the new concept, then you are going to add it to the existing one you have. In that case, you do better. But if you narrow your mind to what you have known before, you are not given allowance for your brain to accommodate new entries. So that's not going to help you at all. Please, let's move on because of time. That's what I have for you. So let's solve this illustration, and hopefully within the next 1 hour we are going to be done. So I'll be very fast in the sense that there's nothing here that we have not done before. Yes, Matthew, talk to me quickly.
Sir, this illustration we want to treat now, which of the question are we going to see it in the material?
I go to is in your material, and I just copied it from the material. I think that should be illustration number 18 or thereabouts in your material. I don't know the page, but it's on illustration number about 18. You can go to, I don't know the page, whether page 54 or thereabout. I don't know. Search your learning material. You say there. You can just search for Jane Daddy. It will bring you. It will take you to the page. All right, Matthew. Okay.
I've seen
so
illustration
18. So I need one of you to read for us. Who is helping us to read? Yes, Matthew, help us to read, since you just finished speaking.
Okay, sir. Okay, sir. The directors of Jane Daddy PLC, JP, an Abuja-based entertainment company, are currently considering the appropriate cost of capital to use in appraising capital investments. It is the policy of the company to assess the financial viability of all capital projects using net present value criterion. You have been provided with some financial information of the company. Most recent statement of financial position containing equity, finance, and so on. Then additionally now, I'm continuing. JP has an equity beta of 1.2, and the dividend market value of the company equity is 1 billion naira. The interest market value of the convertible bond is 168 million naira, and the dividend market value of the preference shares is 50 million naira. The convertible bond of JP have a conversion ratio of 19 ordinary shares per bond. The conversion dates and redemption dates are both on the same date in 5 years' time. The current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. The equity risk premium is 5% per year, and the risk-free rate of return is 4% per year. JP pays profit tax at an annual rate of 30% per year. Required: A. Calculate the market value after tax weighted average cost of capital of JP, explaining clearly any assumption you make. B. Discuss why market value weighted average cost of capital is preferred to book value weighted average cost of capital when making investment decision.
Thank you very much, Matthew. So you can mute. That is the question. All right. So that is the question. Examiner is asking you to calculate market value weighted after tax weighted average cost of capital. You recall when I was explaining the concept of WACC, I mentioned that there are two methods of calculating WACC. You can either use market value method or book value method. Of course, the two different methods will produce two different results. Of course, the WACC using market value will always be higher than the WACC using the book value. Okay, so in this particular question, the examiner was specific. All right, you have to calculate market value after tax weighted average cost of capital. That's what you want to do. You then need to ask yourself, what kind of work is the examiner asking me to do? Is it traditional work, project-specific work, or weighted average cost of capital of the combined activities? Of course, in the question, examiner has given to you ordinary share capital. You have been given 7% convertible bond. You are also given 5% preference share. So this is the capital structure of Jindadi PLC. So because you are given capital structural information, then in that case, you are going to compute traditional weighted average cost of capital. And we said that to calculate traditional weighted average cost of capital, you can either use, you are going to start with cost of equity. So to calculate cost of equity, you check what information are you given or which method are you using. Do you want to use dividend valuation model, capital asset pricing model, or Miller and Modigliani formula? So we said that when information about dividend and share price are given, that is when you use the dividend valuation model. In this particular question, we are not given information about dividend. All right, you're only given the market price of the ordinary share. We are given ex-dividend market value of company's equity. So the market value of equity is 1 billion naira. That's what you are given. We don't have information about dividend. So the dividend paid or dividend to be paid is not given in the question. In that case, you cannot use dividend valuation model to calculate cost of equity. During our discussion of cost of equity, I mentioned that we did not do anything about capital asset pricing model because I mentioned to you that capital asset capping will be treated separately on its own because it's a topic. All right, it's a topic on its own under financial management, which we are going to dissect when we get there. However, because this is an exam question, for us to be able to solve the question, to calculate your cost of equity, since we are not given ordinary share capital, then it could be either you are going to use capping information or you are going to use Miller and Modigliani. Like I mentioned, Miller and Modigliani formula is outside the scope of your syllabus. Of course, Mr. Shiwaju must have given you the same formula when he was taking your capital structure, theories of gearing. But that notwithstanding, when you get to professional level under adjusted present value, we are going to use that particular formula. But for now, the most appropriate method to calculate cost of equity in this question is capital asset pricing model. Why? Because when you are calculating capital asset pricing model, you need information about risk-free rate of return, the beta value of the company, as well as the market return. So in this question, you are given equity beta of the company to be 1.2, right? You are also given equity risk premium, okay, to be 5%. Not only that, the risk-free rate of return given in the question is 4%. So what that simply means is that we are going to use capital asset pricing model to calculate cost of equity. Once we are done with cost of equity, we then calculate cost of preference share, because in the question, we're also given 5% preference share. Okay, so you calculate cost of preference share. What kind of preference share is this one? Is it redeemable or irredeemable? Of course, in the question, we don't have anything like redemption dates. No other information again given in the question that relate to preference share, apart from the ex-dividend market value of 15 million. All right, no other information again. So since you are not given the redemption date for the preference share, that means we are going to calculate cost of irredeemable preference share, which is the ratio of fixed dividend to ex-dividend share price. Then we proceed to step 3 to go and calculate cost of convertible bonds. All right, we calculate cost of convertible bonds. And we said that cost of convertible securities are calculated like internal rate of return. Okay, It's anytime you want to calculate cost of convertible securities, simply go ahead and calculate internal rate of return. And that's what we are going to do here. And then step 4, you just calculate your weighted average cost of capital. It's as simple as that. So without further ado, so let's quickly solve this question. So I will then come here, solution. All right, the name of the company is, let me remove this. So the name of the company is Jindadi. So I'll come here. Sorry, Jindadi PLC. Okay. So what are you asked to do? You want to calculate market value after tax weighted average cost of capital. And we said the first step you are going to do is to calculate cost of equity. You then say calculating cost of equity, denoted as KE. How do you calculate cost of equity? Let me go up there, just pick formula so that it will be faster. We've calculated it last week. Looking for, okay, let me just use this one. I still have to change that. No, let me just write a fresh formula. And I will continue to copy from there. Who is doing crew in my class? Who is that? Amarachi, mute. Okay. Sorry. I've taken my mouse to somewhere else because of Amarachi. What am I looking for, Seth? Okay, formula. All those formula I've been using before is not good enough. Let me just do a fresh formula once and for all. So KE equal to this formula self. I have to do it again. Because of my pain that is not working, I've been struggling with my work has been very slow. Okay, I think this is better. Let me just copy this. All right, so that's that. So we said to calculate cost of, oh, sorry, we are using, I've forgotten. Okay, I will still need this one. Let me just push it down. So because, let me just put it down for you. Because of, for the purpose of this class, that's what I'm writing is that the cost of equity will be calculated using capital asset pricing model. Since information about risk-free rates of return, risk-free rates of return. Don't go and be writing things like this on the day of your exam. I'm doing this for your own understanding. So if you write it on the day of your exam, examiner will not penalize you. You are just going extra mile. But if you don't have the time, don't do this. If you know that you have luxury of time or you really want to express the examiner, go ahead, provided you'll be able to complete all the 5 required questions. Other than that, go straight to the point. Don't waste time. Okay. Since information about risk-free rate of return, markets return, and beta value are given. Okay, so that's why we are using capping. It will be calculated. KE will be calculated using the formula below. You are my baby, so I have to take good care of you so that you understand the reason why we are doing it the way we are doing it. All right? So that's why I'm not rushing you. The only thing is just that I'm not happy because of the fact that your performance in the assignments is not encouraging at all. And I will keep on to say it to your hearing so that you can sit tight, sit up. All right, so to calculate cost of equity using capping, it is computed as risk-free rate of return plus the beta value. Let me pick the beta. Beta, come, where are you? Beta. Plus beta value multiplied by market return minus risk-free rate of return. So this is the formula for calculating cost of equity using capital asset pricing model. Let me define the variables where RF equal to risk-free rate of return. Risk-free rate of return is the rate of return associated with the government security. Like, for example, government treasury bill or federal government bond. So any interest rate or rate of return associated with government security is known as risk-free. So risk-free in the sense that your money, investors' money are secured when you invest in government securities. You can't lose your money. That's the interpretation. All right, you can't lose your money. Soldier go, soldier come. All right, barracks will remain the same. So government is continuum. If the previous government refused to pay your money, the current one will pay. If the current government refuses to pay, the incoming one will pay. So government will always be there, provided a country is still existing. All right, that's why investing in government security is always a risk-free. Okay. Then we also have RM, which is equal to market return, or we call it return of the markets. Then the difference between market return and the risk-free rate of return is called market risk premium. Market risk premium. All right. So according to the question, the risk-free rate of return given to us. Okay, let's pick it. From the question, you are told that the risk-free rate of return is 4% per year. Okay, so here is equal to 4%. Then beta value, as given in the question, is equal to 1.2. You are told that JP has an equity beta of 1.2. You use beta to measure risk. Okay, so when we get to project specific, we'll be talking more about that. Then market return is not given in the question. So, but we are given risk premium to be equal to 5%. Let me confirm that. Yes, equity risk premium is 5% per year. So the difference, examiner did not give to you market return. So you are given the difference between market return and risk-free rate of return, which is risk premium, and it is 5%. So in this case, I can then say my cost of equity using capital asset pricing model is risk-free rate of return of 4% plus beta value, all right, The beta value given to us in the question is 1.2. And the market return, according to the question, we are not given market return, but we are given risk premium, which is different between market return and risk-free rate of return. We are given as 5. Therefore, cost of equity will then be equal to 1.2 multiplied by 5. That's 6. 6 plus 4 equal to 10%. Cost of equity is 10%. Cost of equity of Jane Daddy is 10%. So step 1 is gone out of 4 steps. So let's go to step 2. Step 2 is to calculate cost of preference share. Yes, Matthew, what's your question?
Okay, sir, the formula that we are using now, like in calculating it, we don't convert it to, we don't use the percentage in the calculation till the final answer. Like the 4%, now you only use 4.
Just the way I've done it. All right. Just the way I've done it. Okay, Matthew. Your percentage when you are using capping is on the final number. All right. So let's go ahead and calculate cost of preference share. Like I said, this is irredeemable preference share because we don't have information about redemption dates for the preference share. Therefore, I will then come here. Let me just copy this. Okay, this is number 2. Step number 2, calculating cost of preference share. Let me call it irredeemable. Cost of irredeemable preference shares. KP, denoted as KP. So to do this, okay, let me just help you further. Since the redemption dates of the preference share is not given. It's not given. The KP will be computed as cost of, the KP will be computed as the ratio of fixed dividend to X dividend share price as shown below. All right, so you're already familiar with this, but just to demonstrate for you why we are using this, particularly because of those that are just joining. So this is calculated. The cost of irredeemable preference share is computed as the ratio of fixed dividend to X dividend share price. Okay, or multiply by 100%. Multiply by 100%. All right. We then go back to the question and pick the number, the formula that we, the variables that we need. Okay. Let's go and pick. Get out. We'll ask you. Let's pick the variables that we need. So we need fixed dividend. That's the numerator. I will then go to the question. How am I going to get my preference dividend? Remember, We said that preference dividend is a nominal rate on the nominal value of the preference share. In this question, the nominal value of the preference share is quoted at 1 naira. So the preference shareholders are entitled to 5% of 1 naira nominal value because it is fixed. Therefore, you need to multiply 5 multiplied by 1 naira, then divided by the market price of the ex-dividend market price of the preference share. So according to the question, examiner told you that ex-dividend market value of the preference share is 50 million. So you are not given ex-dividend share price. So you are given market value. So you need to convert the ex-dividend market value to ex-dividend share price. So let's have our working somewhere here. Working number 1. We want to calculate preference dividend first. Preference dividend. Okay. So preference dividend will be computed as, let me shorten it. Preference dividend per share. That's PDP, PDPS. All right. So PDPS equal to preference dividend per share is calculated as nominal value multiplied by nominal rate. Nominal rate. All right, so PDPS will be equal to the nominal value in the question is 1 naira. At times, examiner can say it is 0.25. Okay, whatever it is, just use your nominal value, then multiply by nominal rate is 5%. Therefore, PDPS is equal to 5 kobo, 0.05. I don't know who is doing crew in that place. Be careful before I bounce on you. That person, there are 3 of you. Ruth, be careful. Shola, Atimiri, Ruth, Ansin, Bob, mute yourself. They are not the one lecturing. Yes, your mic is on. Be careful. So this is how to calculate the preference dividend per share. We have done this before, so I will then come here. This is 0.05. Next, I need ex-dividend share price. Ex-dividend share price is not given in the question, but examiner has given you ex-dividend market value of the preference share. So we need to convert that to ex-dividend share price. Okay. So to do this, PDPS. So to do this, come here. I want to calculate X dividend share price. Okay. So X dividend share price. This is, let me shorten it, X dividend share price. This is computed as the total market value. Let me copy this and use. It will be computed as total market value of preference share divided by number of preference share. Okay, so this will be computed as total market value of preference share X dividend share price of the preference share. Okay, so total market value of preference share divided by number of preference share. Number of preference share. All right. So in this case, this will then be equal to the total market value of the preference share according to the question is 50 million. Then divided by, let me just copy this. So 50 million naira. 50 million naira divided by number of preference share. Let's go back to the question. What is the number of preference share? The nominal value, the book value of the preference share is 80 million naira. So you then divide the 80 million naira by 1 naira. So that will give us 80 million shares. Okay. This is 80 million shares. That is 80 million naira divided by graph. 80 million naira divided by 1 naira. So that is what gave us the okay. It was suggesting for me. It was suggesting for me and I was rejecting it. You see life. Somebody that was trying to help. It's okay. Let's leave it as that. So what do you then have? The ex-dividend share price will then be equal to X dividend share price equal to 50 divided by 80. What do you have?
0.625.
0.625.
0.625. All right, so that's that. So I will then come here. Here is 0.625. So multiply by 100%. What's your final answer? KP equal to, yes?
80%.
80% or 8%? That's 8%.
8%.
So cost
8%.
So cost of irredeemable preference share is 8%. Okay. Next one, step 3 is to calculate cost of convertible bond. We are given a convertible bond, 7% convertible bond at nominal value of 160 million. So let's calculate cost of convertible bond. Step number 3, calculating cost of convertible bonds, denoted as KD. And we said that convertible security is computed as internal rate of return by assuming two discount rates that will produce two opposing NPV. That is, one discount rate will produce a positive NPV and another discount rate will produce a negative NPV. We then use the internal rate of return formula to calculate cost of convertible security. However, when you are calculating your NPV, at all time, you have to select the higher of redemption value or conversion value. Okay? Remember, we said convertible securities are fixed income securities that can be converted to a known number of ordinary shares at a specified future date. And I gave you the examples of convertible securities to include preference shares, bonds, debenture, or loan notes. All right, those are fixed income security that can be converted, that has the future of convertibility. All right. So we have done this in the past. We have tested it with examples. So again, this is another question for us to demonstrate that. So we want to calculate internal rate of return. Let me go up there and just pick the table we have used before. Where is that again? Is it this one? Yeah, let's use this table. It's okay. This will save time a bit. All right. So we want to calculate cost of convertible bonds. So, and I told you anytime you want to calculate internal rate of return under cost of capital, always start with 10%. All right. Always start with 10%. Why? Because if 10% gives you a positive NPV, then you can increase to 15% to get a negative NPV. If 10% produces a positive NPV, sorry, a negative NPV, you can reduce to 5% discount rate. So the first item when you are calculating your net present value is to start, we are starting from year zero. In this year zero is where you are going to have the market value of the security. In this case, the security is convertible bond. Therefore, let's go back to the question and pick the market value of the convertible bond. So according to this question, the examiner told you that X interest market value of the convertible bond is 168 million naira. So this is total value. Examiner has given you total market value of the bond. So since we are using par value, so we need to convert this total market value of 168 million to per unit of the bond. All right, so working number 3 now. Where is working number 2? This is working number 2. Okay. Let me just copy that. Working number 3, I want to calculate X interest price. X interest price is not given in the question. Instead, you are given market value of the bond, total market value of the bond. So we need to convert that to X interest price. That we're asking. You will recall in some of our previous classes, let me push this one down a little bit. X dividend share price. So you recall in one of our previous classes, we said that to calculate market value, let me show you. If I'm the one solving this question on the exam date, I will not do it the way I want to do it now. But for the purpose of explanation, that's what I will do it this way. We said that market value of debt, that is debt value, denoted as E. Denoted as E is computed. So it's computed as nominal value multiplied by, let me copy this. Multiplied by X interest price, okay? Multiplied by X interest price. I miss my pen. That's why my work is slower. I have to find a way of resolving it because this typing is wasting my time. Okay, so this is the formula for calculating market value of debt. You're already familiar with this formula. We have used it in the past severally. Okay. So to then calculate this, examiner has given us, sorry, this is D, not E, debt value. So examiner has given us D, the debt value to be equal to 168 million naira. All right. So the nominal value given to us in the question is 160 million naira. The X interest price, we don't know it. That's what we want to calculate. 100 naira is constant because debt is always quoted at 100 naira per unit. So if that is the case, we can then solve further. So let's assume the X interest price is equal to X. Let it be equal to X because that's unknown figure. That's the figures we are looking for. So let's make it equal to X. Let me push it outside. Let's X interest price equal to X. All right. Therefore, this guy will be equal to X here. This is X multiplied by 160. X multiplied by 160 will then be 160X. Because of time, don't need for us to be doing all this one by one. So this will just be equal to 160X. That's it. Remove this. 160X, because if you say 160 million multiplied by X, that will give you 160X divided by 100. You then cross multiply. When you cross multiply, this will then become 168 multiplied by 100. So X will be equal to, let me reduce this one. So the X will be 168 multiplied by 100 divided by 160. That's it. It's as simple as that. This will then be equal to 16,000, sorry, 168. Error of mind. Yeah. Thank you. So this will then be equal to 16,800. 16,800 divided by 160. What do you have there?
105.
105.
105. That's it. So if I'm the one solving this, I won't do it this way. It's just because I want you to understand how I got the number. Ordinarily, I know that the nominal value is 160, and that nominal value will always be the denominator. So I'll just say 168 divided by 160 multiplied by 100 naira, because debt is always quoted at 100 naira per unit. I will still get the same answer. I will say 168 naira divided by 160 naira, all multiplied by 100 naira, because debt is quoted at 100 naira per unit. So I will get the same thing as 105. So that's that. So now that we have the X interest price to be equal to 105, I can then proceed with my calculation. So the market value is 105. The bond interest has been paid. Therefore, I don't need to make any adjustment to the 105. But if interest has not been paid, right? If interest has not been paid, I can't use this 105. I have to convert it to X interest price, but it's already X interest. So that's why we are using it. The next one is fixed interest. The company is going to pay interest on the convertible bond. Therefore, what is the percentage of the convertible bond? The interest rate is 7%. Okay. So ordinarily, I'm supposed to come in and put 7 naira, because 7% of 100 naira unit will give you 7 naira. So ordinarily, I'm supposed to write 7 naira there, but I can't do this. Why? Because of the fact that in the question you are given tax rates. Okay, the examiner has given you a tax rate of 30%. So because we are given tax rate of 30% and tax is paid, you can see examiner did not tell you whether tax is payable 1 year in arrears or in the current year. Because examiner is silenced, you are going to assume that tax is paid in the year profit is earned. That is, in the same year is what there's nothing like 1 year in arrears. So 30% tax is given. Therefore, I need to go and calculate post-tax interest. So I want to calculate post-tax interest. Okay, this is post-tax. This is working number 4. Judith, well done. Well done. So, post-tax interest. Get out. I did not ask you. Post-tax interest is computed as interest multiplied by 1 minus tax. 1 minus tax rates. Okay. So in the question, interest rate is 7% of 100 naira, which is 7 naira. Then multiply by 1 minus tax rate. Tax rate is 30%, so 0.3. Therefore, post-tax interest will be equal to 4.9. That is 7 multiplied by 0.7, that's 4.9. So I can then come here. Instead of 7, this guy will be 4.9. So I also need to go back to the question. When is the redemption date? When is the exercise date for this convertible security? According to the question, you are told that the conversion date and redemption date are both on the same date in 5 years' time. So this means that the company is going to pay annual fixed interest for the next 5 years. So since tax is paid in the current year, so we are going to do year 1 to 5. Somebody should give me an annuity factor of year 1 to 5. We have done it severally in the past. Before that, then in the final year, at the exercise dates, remember what I told you when I was explaining this concept. I said that when you are calculating your NPV in the final year at the exercise date, you need to compare the higher of redemption value or conversion value. You want to know whether the bondholder should convert to ordinary shares. And I mentioned to you in my explanation that investor will only convert to ordinary shares if it is profitable. That is, if conversion value is higher than the redemption value. If conversion value is lower than the conversion value, the investor will not exercise the right to convert to ordinary share. They will just allow the security to lapse and then redeem it at the maturity date. So let's go and calculate. Let's determine the conversion value. That will be working number 5 now. So working number 5, conversion value. Okay. Get that. Let me remove that. So conversion value denoted as CV is computed. Conversion value is calculated as number of ordinary shares that you want to convert to, number of ordinary shares multiplied by the market price, that is share price of the convertible at the exercise date. by all means, I have to find a way of getting my pen back. If not, all this type, I could have written it on the board and on the screen, then move on. So, according to the question, you are told that the bond can be converted to, where is that again? Yes. In this paragraph, you are told that the convertible bond of JP have a conversion ratio of 19 shares per bond. So you are going to convert to 19 ordinary shares. All right. So here will be equal to 19 shares multiplied by, I need the conversion value. I need the share price. All right, I need the multiply by share price. I don't know the share price. Let's go back to the question and pick it. Examiner told you in the question that the current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. So the current share price of the ordinary share is not given, but we can get it. How? Because in the question you are given ex-dividend market value of the company's equity to be 1 billion naira. So market value of equity is 1 billion. So just divide the 1 billion naira by the number of ordinary shares. It will give you the current share price. All right. So number of ordinary shares is 200 million shares. Maybe I should move faster. All right. So I'm going to work in number 6 now. I don't know the share price because this has to be the share price as the exercise date. All right. So the examiner has told you that the current share price will increase by 4% for the foreseeable future. All right. So we need to first of all calculate the current share price. So I will then say current market value, current share price of the ordinary share of ordinary shares. Okay, that's working number 6. All right, so to do this will be computed as current market value per share. Let me put this for current market value per share equal to, let me copy, equal to total market value. Don't waste my time. Equal to total market value divided by number of ordinary shares. This is total market value of equity divided by number of ordinary shares. Okay. So according to the question, total market value is 1 billion naira. Okay. Number of ordinary shares is 200 million. 200 million shares. So when you divide 1,000 by 200, we give you 5 naira. So the current market value per share is 1 naira. Sorry, it's 5 naira. So I can use the 5 naira here to multiply 19 shares. That's not possible because the examiner has told you in the question that the preference share, sorry, the current dividend will increase by 4%. All right, we increase by 4% for the foreseeable future. Therefore, we need to go and calculate the market value at the exercise date. So that will take us to working number 7. because you can't use the 5 naira directly like that. When you do that, that means you have not factored in the growth rate. So share price at the exercise dates, or share price for the convertible, for the convertibles, for the convertible bonds. All right, so that's what we want to calculate. So all we need to do is to just factor in the growth rates. So let me denote this one as SP. Let me denote it as SPV, share value of the convertible, SPV. All right, so in this case, I will just say SPV, share value of the share price of the convertible, will be computed as let me see, I need to include formula. This should be computed as which one am I using, self? Okay, let me start with brackets. After brackets, then I will have this. Okay. Raised to power. Let me just put all of them there. Anyone I need. Okay. All right. So this will be computed as A multiplied by 1 plus R, 1 plus G raised to power N. All right, 1 plus G raised to power N. This is N. Let me remove the other one here. Oh, it will not allow me. Let me see if that will be possible. This. Okay, good. So raised to power N. So this is the formula. Anytime you are told that your share price or cash flow will increase at a specific growth rate, you are given a specific growth rate, then in that case, you are going to use this formula. All right. You know, we have not used this. This is not part of the thing we discussed previously. The reason why we are using this is because in this question, the examiner has told you that the share price, the current share price of 5 naira will increase by 4% for the foreseeable future. So to incorporate the growth rate, this is the formula that you are going to use. Where, let me define the variables for you. Don't waste my time. Where SPV is the share price for the convertible. Okay. That is the share price at the exercise dates. Then, of course, A is equal to the current market value or current share price. Then, G equal to growth rates. All right, G equal to growth rates. Then N is the time period. N equal to time period, which is, according to the question, 5 years. The growth rates, we are given it to be 4%. The current share price, we calculated 5 naira. That is working number 6. Okay. All right then. So I can then come back here to say SPV equal to A is equal to, which is current market value, and it is 5 naira. The growth rate in 5 years' time at the exercise date is 4%, 0.04. Then when is the exercise date? In the next 5 years. So N is equal to 5. So what do you have? 1.04 raised to power 5 equal, multiplied by 5 equal. What's your final answer?
6.08.
6.08. Thank you. 6.08 is the market value at the exercise dates. So that is that. This is what you are expected to do. If you don't do it this way, there's no way you get the right answer. Let me reduce this. Okay, so I can then come back here. Based on our calculation, this is 6.08. We calculated this at working number 7. That's it. Therefore, CV will be equal to, what do we have? 19 multiplied by 6.08. What do we have?
115.52.
115.5. So that will give us 116 naira. So Randy, that's it. That's the current market value at the exercise dates. That will be our, that will be our conversion value. We then compare this conversion value with the redemption value. Okay, so let's make our redemption value to be number 6. Working number 6. Redemption value, which is equal to, according to the question, we are not told the value of the redemption value. If the bondholder wants to redeem the bond, at what price? Okay, since we are not given the price, it has to be at 100 naira per unit. Remember, debt is always quoted at 100 naira per unit. So the par, it will be at par. All right, because the par value is 100 naira. If it's at a premium, it will be higher than 100 naira. If it is less than the 100 naira, that means at a discount. So in this question, the examiner did not tell you how it will be redeemed. You are just given the redemption date to be in 5 years' time. All right, but you are not told how it will be redeemed, whether at par, at premium, or at a discount. So where you are not told, you are going to assume it will be redeemed at par. So the par value is equal to 100 naira. The redemption value equal to 100 naira. Let me bracket this, RV. Okay. I wish we can just finish this one now. Let me make this one to be number 6. Okay. In fact, no need to even be doing this. Let me just push this one down. Yeah. So the next thing we then need to do is to compare. This is working 7. Let's make this one working number 8. So you then compare the higher of the redemption value and the conversion value. The conversion value is 116 naira. If this bond is going to be redeemed in 5 years' time, it will be at par, that is 100 naira. So since the conversion value is higher than the redemption value, it means that the bondholder will exercise their rights. Let me just put it here. Note: the bondholder, the bondholders will exercise their rights to convert to ordinary shares since the conversion value of 116 naira is higher than the redemption value of 100 naira. Okay, so that's that. So that's why we are selecting 116 naira. So I will then come here in my NPV calculation. I will then write conversion value. Conversion value. So the exercise date is in 5 years' time. Here will be 116. If you like, you can say this is working number. This is working number 6, right? Let me confirm it. I think it is working number 6, number 5. So that you know I will pick the number. All right then. Okay. Now, discount factor for year 0 at 10% is 1. Then I need annuity factor of year 1 to 5 at 10%. We've done this before. All right. Annuity factor of year 1 to 5 at 10%. That will give you
3.79.
791. Thank you. Then discount factor for year 5 at 10% will give us 0.621. So let's multiply now. There will be 105. Somebody should multiply 4.9 by 3.791.
Right.
What do you have?
18.575.
0.58.
That's 19. Rounding, 19. 116 multiplied by 0.621.
72.
72 plus 19. That's 91. 91 minus 105.
91.
What do you have? 91 minus 105. What do you have?
Minus 14.
Minus
14.
14.
Minus 14.
So we assume 10%. We had a negative NPV of 14. So let's reduce to 5% so that we can have a positive NPV. So somebody should give me an annuity factor of year 1 to 5 at 5%.
$4.33.
4 point what?
4.33.
0.329.
329.
Okay. Yes.
Then discount factor for year 5 at 5%.
0.784.
0.784. So let's multiply. 4.9 multiplied by 4.329.
21.
21. Then 116 multiplied by 0.784.
91.
91. So
91.
91 plus 21 minus
112.
105. Minus
7.
105. 7. So we assume 10%. We got a negative NPV of 14 naira. We then reduced our discount rate to 5%. We got a positive NPV of 7. Now that we have a positive and negative NPV, we can then proceed to calculate cost of convertible bond, okay, which is the same thing as internal rate of return. So we assume 5% and 10%. So 5% is lower. So that will be 5. A is the lower discount rate. Then NPV of the lower. B is the higher discount rate. So the lower discount rate produce 7 naira NPV divided by 7 naira, then plus the higher discount rates NPV of 14. So 17 divided by 21 equal, multiply by difference between 10 and 5, which is 5, then equal plus 5. Final answer, what do you have there?
6.67.
What do you have?
6.67.
6.7%. 6.67%. So approximately this will be 7%. KD is approximately 7%. Let me use approximation sign. Approximation 7%. All right. So finally, we need to calculate weighted average cost of capital. Step 4, calculating step number 4. That is the final step, calculating WACC. Let me just write WACC. On the day of your exam, don't go and be writing WACC. You have to write it out in full in the first instance. Calculating weighted average cost of capital. Don't go and write WACC. So let me just copy the formula we have used before. Okay. Let's copy this. All right. So WACC, denoted as KW, is computed as equity value over equity plus debts. There is no preference sharing. Oh, sorry, we have preference share. I made a mistake there. Should have copied the entire. I was taking is only ordinary shares and debts. Let me recopy it. Since we have the 3, let me just copy everything. All right. So WACC is computed as equity value divided by total market value of equity, preference share, and then debt multiplied by cost of equity plus market value of preference share divided by total market value multiplied by cost of preference share plus market value of the bond over total market value of equity, preference share, and debt multiplied by after-tax cost of debt. So we need to calculate the market value of equity. According to the question, market value of equity is 1 billion naira. Cost of equity, we calculated 10%. Market value of the preference share is 50 million naira. Right? Cost of preference share, we calculated it to be 8%. Then market value of the bond is 168 million. So we need to calculate total. Let me make it working number 9. Working number 9. Total market value of equity plus preference plus the debts. So total market value will then be equal to value of equity is 1,000, that is 1 billion naira, plus value of the preference share, 50 million, plus value of the bond is 168 million. A wise student should have gone ahead. Just give me the total once and for all. What do you have there without asking you? 1 million,
218.
218 million. Thank you. That's the total market value of equity, preference share, as well as the debts. So I can then come here. The denominator is 1218. All right. Same thing. So give me from the left. What do you have from the left? 1,000 divided by 1218 multiplied by 10. What do you have?
8.2.
8%.
8.2. Put two words. Make it 2 decimal
21.
points.
21. 8.21.
So the one in the middle is what? 50 divided by
0.33.
0.33.
0.33.
The last one on your left, on your right.
1.10.
1.10.
1.10.
Okay. So add it up. Sorry, this is
9.64.
7%. Hold on, this is 7%. You know, we calculated 7%. This is it here.
Okay.
Yeah, redo it. 168 divided by 1218.
0.97.
0.97.
Okay, 0.97. Add it up now. That will be
9.51.
9.51%. So this is approximately 9%, 10% rather. All right. So the work of Gene Daddy is approximately 10%. That's that. This is how to calculate cost of convertible preference share. Okay, sorry, cost of convertible debt. So now you know. So let's go back to the question. The B part is just written one. You are asked to discuss why market value weighted average cost of capital is preferred to book value. I've already told you this before when I was giving you the notes. Yes, Gostan, quickly, what's your question?
My question is that 1 minus T, that is the tax rate, that one is not taken into cognizance, or it has been done?
We've already adjusted for tax. You know, when we are calculating cost of debts, here, instead of using 7 naira, we use 4.9, isn't it? So we've already adjusted for tax. That should be working number. Let me just put it down for you. Working number 3, I think. Let me go and confirm it. Working number, no. Post-tax interest. Yes, working number 4. This is post-tax interest. So because you've already adjusted for tax here, so when you get to the when you are calculating your WACC, you don't include 1 minus tax again because you've already adjusted for tax. Okay?
Okay,
Just stand. Yeah, so here is working number 4. So that's that. So in this number B requirement, examiner is asking you to discuss why market value weighted average cost of capital is preferred to book value. Again, I've already explained this when I was giving you the note. First thing first, to answer this question, you are going to explain what is market value, right? You then explain what is book value. Finally, you then discuss why market value is preferred to book value. The reason being that market value is preferred to book value because market value incorporates current market information, all right? It reflects the current market information. The book value is historical. It doesn't consider the current market condition, and hence the reason why the market value is higher, the reason why the market value is preferred over the book value. However, then relate it to this question. You then say the work computed above is approximately 10%. So you need to compare the work using the market value method with the work using the book value method. So in this case, you just go ahead and calculate the work using the book value. This, of course, when you are doing that, remember to calculate work using the book value, you are supposed to add ordinary share capital and reserves. So in this case, the proportion of your equity will be equal to 200 plus 120, which is 320. Okay, so 320 divided by the total value. Okay, so that will then give you the that will be 320 divided by 520 multiplied by cost of equity you have calculated as 10%. Then for the preference share, it will be 80 divided by 520 multiplied by cost of preference share of 8%. Then the book value of the convertible bond, it will be 160 divided by 520 multiplied by after-tax cost of debt of 7%. Whatever you have, you should have something around between 8 or 9%. So when you are explaining the B part, you can then reference it. Don't worry, I will share with you. It's already in the golden book. I will share with you later on. Okay? So let's go to the final illustration on this. Final illustration under the traditional work, the one tested last diet. Let me check this people that are sending chats. You can't hear me. You can't hear me, or I can't hear you, or you cannot hear me, Shola. I don't understand. Please cannot share the study material. Okay. All right then. So let me quickly share the solution to that number B part of the question. I think I have golden book open today. Let me quickly share that. Just 1 minute, please. Get out. Okay. Let me share again. Which question is this one, sir? Jane Daddy, right? I think in the golden book is called Jan Dollar. Control F. Yeah, don't waste my time. Jan Dollar. So I just want to show you the solution to the B part of the question. So this is how I answer the B parts. All right. So examiner is asking you why is market value preferred over the book value in the calculation of work. So to answer this, let me remove this. So to answer this, the first thing you need to do, like I explained, you need to define, or you need to explain what is market value, what is book value. Then you state the reason why market value is preferred over the book value. Okay. And then, of course, you need to put it into practice. You have to link it with the question. All right. Don't just make it generic to just define then move on. So you need to link it with the question. So this is how I answered it. Market value is the current price determined by the market forces of demand and supply, while the book value represents historical price as shown in the statement of financial position. In the calculation of weighted average cost of capital, both the market value and the book value can be used to form the proportion of equity and debt in the company's capital structure. However, in the determination of WACC, the market value approach is usually preferred over the book value because the market value reflects all relevant information required to make informed investing decisions by the market participants. The book value approach is historical and does not reflect new information about the market condition. For this purpose, the use of book value for estimating WACC can result in suboptimal decision. Okay, it can result to suboptimal investing decision. Practically, market value is usually higher than the book value. As a result, the WACC computed using market value will be higher relative to if book value is used. For instance, the current market value of Jindadi PLC is approximately 10%. That's what we got. Whereas the book value is is used. Whereas if book value is used, it will be 9%. See calculation below. Let's go and check the calculation. Now, like I was explaining, when you are using book value to calculate WACC, you have to add up ordinary share capital and reserves. Okay, so in the question, ordinary share capital is 200 million naira, then reserve is 120 million. When you add the two, that's 320. 7% convertible bond is 160 nominal value. Then preference share nominal value is also 80 million. By the time you add them together, you are going to have 560 million. Right, that's the total book value. Therefore, it's the same formula you are going to use to calculate your WACC. So in this case, the proportion of equity is equal to 320 divided by total value, then multiplied by cost of equity plus proportion of preference share multiplied by cost of preference share plus proportion of the bond, convertible bond, multiplied by after-tax cost of the bond. Okay, so by the time you add everything together, your WACC using the market value is approximately 9%. So this is what I was referring to in my explanation here. So like I said, for you to be able to earn your full mark, you need to do all of this. You need to do all of this. If you don't do it, of course, it's not that maybe you are not correct, provided you are able to explain, you are able to explain the meaning of market value, book value, and the reason why market value is preferred over the book value. So for you to be able to earn the full mark, you just have to compare the two, the result of the two. All right. So this is essence of what I've done here. Thus, the use of market value in determining the proportion of each source of financing in a company's total pool of capital is essential because of the significance of cost of equity in the WACC calculation relative to the debts. Generally, irrespective of the method used for the weighting, the contribution of cost of debt will remain constant. All right, will remain constant irrespective of what happens. So it's only the proportion of equity that will always change. The proportion of the debt will always remain because that one is based on the book value. Okay, sorry, it's based on the, it's always constant. Yeah. Okay then, so that's that. Later on, I will just, I will crop this and then I will share with you so that you can have better, you can write it in your notes. Okay, let me stop. Let's go back to our working notes. Let's have one more illustration and that will be the end of a traditional work. So let's solve the question tested last diet. Question number 2. You can go to the past question I shared with you earlier today, a few hours ago, about an hour plus ago. I shared the past question, a Pathfinder question. So go there, go and pick it. All right, go and pick it. I already have it to save my time. I already have it here, and I've also solved it. So I know I may not have sufficient time. So I begin to be doing all of that one by one. So open to the material at your end. So I already have it there. Yes, I need one of you to read for us. Matthew was the one that read the other one. Let me look for another person. Who has offended me today? One of you was making noise the other time. I think it was I mentioned her name. I've forgotten again. I will see now. Okay, I just need guys, I need one of you to read for us. Who will help us? Yes.
Okay, I'll read.
Okay,
I'll
Festus,
read.
go ahead. Thank you.
Okay. Fairly PLC operates a low-cost road transportation business, and the company is listed. By comparison to its major competitors, Fairly PLC is relatively small, but it has expanded significantly in recent years. The shares are held mainly by large financial institutions. The following extracts from Fairly PLC's budgeted statement of financial position as at May 31st, 2025 is stated as follows. Dividends have grown in the past at 3% a year, resulting in an expected dividend of 1 naira per share to be declared on May 31st, 2025. Assume for simplicity that the dividend will also be paid on this date. Due to expansion, dividends are expected to grow at 4% a year from 1 June 2025 for the foreseeable future. The price per share is currently 10 naira 40 kobo SD, and this is not expected to change before May 31st, 2025. The existing bonds are due to be redeemed at par on May 31st, 2025. The market value of these bonds at 1st June 2025 is expected to be 100 naira 84 kobo S interest per 100 naira nominal. Interest is payable annually in arrears on May 31st and is allowable for tax purposes. The tax rate for the foreseeable future is 30%. Assumed taxation is payable at the end of the year in which the taxable profits arise. New finance. The company has now decided to purchase 3 additional vehicles at a cost of 10 million naira each. The board has decided that the new vehicles will be financed in full by an 8% bank loan on June 1, 2025. Required, calculate the expected weighted average cost of capital of Fairly PLC at May 31, 2025. B. Without further calculations, explain the impact of the new bank loan on Fairly PLC's cost of equity, cost of debt, and weighted average cost of capital using the traditional model. C. Explain each and distinguish between bonds and bank loan. In so doing, explain why in the circumstances of Fairly PLC, the cost of debt may be different from the two types of security.
Yeah, thank you very much, Festus. That is the question. Let's see. So the first one, requirement number A, you are required to calculate the expected WACC of Fairly PLC at May 31, 2025. you want to calculate the weighted average cost of capital of Fairly PLC, 7 marks. How do you calculate the WACC? Examiner has told you that you should use the traditional method. Even without asking you, you should know already the method that you are going to use, because examiner has already given you ordinary share capital. You are given a bond of 9%. All right. So that means since information about capital structure is given in the question, you are expected to calculate traditional weighted average cost of capital. Therefore, how do you compute traditional WACC? The first step is to calculate cost of equity. All right. How do you calculate your cost of equity? In the question, you are given dividend. You are told that the dividend of the company of £1 per share declared are to be declared on 31st of May 2025. For simplicity, you are to assume dividend will be paid on this same date, on May 31st. So due to expansion, dividend are expected to grow by 4%. So the dividend of £1 will grow by 4%. So one of you was asking me earlier today that there are 2 growth rates given in this question. I'm solving a question, I have 2 growth rates. Which one should I select? Of course, you can't use the past one. It has to be the future growth rate. All right. So 4%, you are going to grow the £1 by 4%. That will be one naira multiplied by 1 plus growth rate. So that will give you 1.04. 1 multiplied by 1.04 is the same thing as 1.04. Then your denominator, which is ex-dividend share price. The market price of this ordinary share is 10 naira 40 kobo ex-dividend. You can see it's not difficult. But before I even begin to solve this question, let me show you did I have it open? Yes. Let me show you the examiner's report. Let me show you the examiner's report. I don't know if you are seeing are you seeing my screen? The past question?
Yes, sir.
Yes, sir.
Aha. So let's go and check the examiner's report for this question. Look at what the examiner said about this particular question. This question is in 3 parts. The first 2 parts test candidates' understanding of cost of equity, cost of debt, and weighted average cost of capital. The last part requires candidates to distinguish between 2 types of medium, long-term sources of finance, namely bond and bank loan. About 60% of the candidates attempted this question. However, performance was poor. You can imagine, as simple as this question, performance was poor, as less than 30% of them score up to 50 of the marks allotted to the question. The commonest pitfall was the inability of many candidates to articulate the impact of a new loan on the cost of equity, cost of debt, and weighted average cost of capital. This is a reflection of candidates' inability to apply concept to practical situations. All right. So candidates at this level of the examination must develop analytical skill that will enable them to apply concept and principle to simple practical situations, as this is the distinction between skills and foundation level. So I just say I should call your attention to the examiner's report. So let's go back to our calculation. You can see less than 30% scored up to 50% of this question. So you can imagine that means majority of them failed. That's why the examiner said they perform poorly, right? That's that. So this question is too cheap for a student to fail. In this particular question, the examiner combined, all right? The A part of the question majorly is on cost of capital. The B part of the question is talking about capital structure, theories of gearing. When you introduce additional debts, what will be the impact on the company's WACC and the market value of the company? This is one of the things that Mr. Ashwaji was asking you a few days ago in your group. when some of you were talking wah. Only few of you got it correctly. But in any case, because of time, let's solve the question together. So we want to calculate WACC. So first thing first, we need to go and calculate cost of equity. We have identified from the question that the current dividend is 1 naira, and we are told that the dividend has been paid. How do we know that dividend has been paid? Because examiner told you that the price per share is currently 10 naira 40 kobo ex dividend. It means that since you are given ex dividend share price, it means that dividend has been paid. Therefore, we need to go and calculate cost of equity, which is the ratio of dividend to ex dividend share price multiplied by 100%. But since we are given growth rates, we need to incorporate the growth. So this is the way, like I said, I've already solved the A part of the question just to make life easy for us. So it's the same formula that we normally use to calculate cost of equity, because we are given dividend and then share price. So the current share price is 1 naira according to the question. We are given a growth rate of 4%. So 1 plus 4% will give us 1.04. The ex-dividend share price is 10.4. All right. There's no need for you to go and be calculating or to go and deduct 1 naira, the current dividend from the market price. So because your market price is already ex-div, all right, that's 10.5. So 1.04 divided by 10.4, that's 0.1 multiplied by, plus 0.4. So that will give us 14%. So cost of equity is 14%. We then move to step 2. Step 2 is to calculate cost of preference share. In this question, we don't have preference share capital. Therefore, you are going to skip. You are going to skip that, then move to the bond. So we are given 9% bond. Pay attention to this. You are given 9% bonds. This bond will become, will be redeemed in 2028. Examiner has given you 2028. All right. That means that will be for 3 years. If this is 2025, if today is 2025, all right. So from 2025 to 2028, that's 3 years. That means you need to, first thing first, you also need to confirm what kind of debt is this one. Is it redeemable or irredeemable? According to the question, you are told that the bond will be redeemed. All right. So the redemption date is given in the question. That means you are going to calculate cost of redeemable bond. All right. You are going to calculate cost of redeemable bond. All right. So you are told that the existing bond are due to be redeemed at par on 1st of December 20, on May 31, 2025. That date is not correct. The date given in the question is not correct. Maybe that's one. Maybe even that's one of the reasons why some students could not get it correctly, because this one's supposed to be May 2028. Here, examiner has already told you that 9% bond 2028. This 2028 simply means that it will be redeemed in 2028, in 3 years' time. So this one's supposed to be 31, May 31, 2028, not 2025. That is not correct. If the market value, pay attention to this, if the market value of this bond as at 1st of June 2025 is 100 naira 84 kobo, how can the redemption be behind the market value? This market value on 1st of June is 100 naira 84 kobo. This one's supposed to be 2028, not 2025. Okay, but again, as a student, as an average student, for example, you need to be thinking, well, don't let me say average student. You need to be thinking outside the box, because when you are calculating when you are solving this kind of a question and then something is like something is missing somewhere, then you need to find a way. You need to read the question over again and see how you can deduce or identify the variables you are looking for in the question. So examiner has already told you that this bond is 2020, will be redeemed in 2028. Once you see this number of year here, you should know that that is the redemption date. Okay, so in this case, I need to calculate internal rate of return because this is redeemable bond. This is redeemable bond. So the current market value of this bond is 108 naira, 100 naira 84 kobo x interest. So I don't need to make any adjustments. All right. Then interest will be paid for the next 3 years. Interest will be paid for the next 3 years. What's the interest rate? Interest rate is 9% for the next 3 years. Not only that, according to the question as well, examiner told you that tax is payable. There's somewhere where examiner mentioned, so examiner told you here that interest is payable annually in arrears and is allowable for tax purposes. So ordinarily, when you are calculating your cost of redeemable bond, because examiner has mentioned that interest is payable annually in arrears, so there must be 1 year lag, like we did in the question of Courage PLC, right? Where we calculated annuity factor of year 2 to 3. Okay, because tax is payable 1 year in arrears. So the same thing you are going to do, you are supposed to do here. But examiner is aware of the fact that there may be some students that may not understand how to calculate annuity factor in between years. Victor, you are writing on my screen. Stop it. So there may be some students that will not be able to calculate annuity factor in between years. That's why examiner now told all of you that assumed taxation is payable at the end of the year in which taxable profits arise. Okay, so that in this case, there's nothing like 1 year in arrears again, because examiner has told you to assume that tax is payable in the year that the profit is earned. So no issue. So, and that's what I've done here. Step number 2 now, I calculate cost of redeemable bond. To do this, we calculate internal rate of return. The first thing first is to determine the current market value of the bond. According to the question, the current market value of the bond is 100 naira 84 kobo, right? Then we are told that interest is payable in the year tax profits arises, and tax profits arise. So in that case, there's nothing like 1 year lag. Therefore, I will then go to the question, what is the interest rate? According to the question, the interest rate on this bond is 9%. You are not supposed to use the 9%. You need to go and convert it to after tax. I've told you this severally. Anytime you are calculating cost of debt, you must adjust for tax if tax rate is given to you. So we have tax rate of 30%. Therefore, I need to go and calculate after tax interest, that is post-tax interest. This is it. That's my working number 1 here. So to calculate post-tax interest is interest multiplied by 1 minus tax rate. Interest rate is 9% of 100 naira, which is 9 naira, multiplied by 1 minus tax rate. So that's what gives us this 6.3. And that's the 6.3 you have in the table here. All right. The next one is the redemption date. This bond will be redeemed at par in 3 years' time. So redemption value will be 100 naira because examiner told you it will redeem at par. Yes, Evelyn, what's your question?
Sir, what about if tax rate is not given? Are we going to use just the percentage of the debt directly? If tax rate
If
is not
tax rate
given
is
at
not
all?
given to you, just ignore adjustment. No need to do post-tax interest. Just use 9. For example, just use 9 if tax is not given. All right.
Okay, thank you.
Yes, Ruth, what's your question?
Okay, sir. In calculating this redeemable bond, why are we not comparing with the rate of conversion as well?
Conversion. Is this a convertible bond? Is it a
Oh, okay.
convertible bond?
No, 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 it's not. It's a redeemable bond. Okay, I get.
It is only when you have convertible security that you can of redemption value and conversion value. So this is not a convertible bond. All right.
Okay.
Okay then. So you can put down your hand, Ruth, unmute. Yes. Next. So we are calculating cost of redeemable bond. Yes. In the final year, which is year 3, this bond will be redeemed at par. At par means at 100 naira. Therefore, I need to go and calculate annuity factor of year 1 to 3 at 10%. I've done the working here, something we have done severally. Annuity factor, this is the formula for calculating annuity factor. You already know it. So annuity factor of year 1 to 3 at 10% will give us 2.487. Then this is the formula for calculating discount factor. You calculate annuity factor if you have constant cash inflow. You calculate discount factor if just for specific year. All right, so for year 3, discount factor at 10% is 0.751, and that is what you have here. Annuity factor of year 1 to 3 at 10% is 2.487. Discount factor at 10% for year 3 only is 0.751. So you then multiply 1 multiplied by 100.84. We have 100.84 present value in year 0. 6.3 multiplied by 2.487. We are going to have present value of 15.67. Then 100 multiplied by 0.751. We produce 75.10 present value. When you add up 15.67 plus 75.10 equal minus 100.84, you are going to have a negative NPV of 10.07. So we assume 10%, and we got a negative NPV of 10.05. We then reduce our discount rate to 5% in order to get a positive NPV. We then proceed again. It's still the same cash flow that you are using, right? So you then proceed again to go and calculate annuity factor of year 1 to 3 at 5%. And we got, when you put it in the formula, we got 2.723. Discount factor for year 3 at 5%, we got 0.864. And then that is what you have here. Okay, 2.723. Then discount factor for year 3.864. When you multiply 6.3 multiplied by 2.723, we got present value of 17.15. Then also 100 naira multiplied by 0.864 will give us 86.4. Then you add together 17.15 plus 86.40, then less 100.84. We got a positive NPV of 2.71. So now that we have two opposing NPV, we have a positive and negative NPV. We can then proceed to calculate cost of redeemable bond using internal rate of return formula. Okay. Now, A is the lower discount rate of 5. B is the higher discount rate of 10. NPV of the lower discount rate is 2.71. NPV of the higher discount rate is 10.07. Therefore, from your calculator, you then say 2.71 plus 10.07 equal, all right? You keep it on one side. They then say 2.71 divided by answer equal, multiply by difference between 10 and 5, which is 5, equal, plus 5, equal. You are going to get 6.06%. So approximately, the cost of redeemable bond is 6%. Okay? So then, step 3, since we don't have preference shares, step 3 is to then calculate weighted average cost of capital. To calculate the WACC, you need the equity value, all right? You need the equity value plus the value of the preference share, value of the debt. We don't have preferential in the question, okay? We don't have preferential in the question. So equity value divided by equity plus debt value multiplied by cost of equity plus debt value equal to debt value divided by equity plus debt multiplied by cost of debt. So I need to go and calculate market value of equity and then market value of debt. I've told you anytime you are calculating WACC, you have to use market value to do the weighting. All right, you have to use the market value. You don't use book value except examiner asks you to use book value. Therefore, let's go and calculate market value of equity and debt so that we can calculate our WACC. So that will take us to working number 3. So to calculate the market value of equity, you know that equity value is calculated as ordinary shares multiplied by ex-dividend share price. According to the question, number of ordinary shares is 100 million. Okay, we are given 100 million shares multiplied by ex-dividend share price is 10 naira 40 kobo. Okay, ex-dividend share price is 10 naira 40 kobo. When you multiply the two, that will give us 1 billion and 40 million naira. That's the market value of equity. We then proceed to calculate market value of the bond, which is debt value. And we say debt value is computed as nominal value multiplied by X interest price divided by 100, because debt is always quoted at 100 naira per unit. Okay, so debt value, according to the question, is 200 million naira. Okay, debt value is 200 million naira. Let me confirm that this is it. Debt value is 200 million naira. That's the nominal value. Nominal value is 200 million. All right. Then multiply by X interest price is 100 naira 84 kobo divided by 100. So you are going to get the debt value is 201 million naira 601 million 68,000 naira. So that is the value, that is the market value of the bond. All right. So to make life easy for you, for yourself, so you need to add up equity value plus debt value, and we got 1241.68 million. So that's that. So in the calculation of our work, equity value is 1,040, that is 1.04 billion. Then total market value of equity and debt is 1.24 billion. All right, then multiply by cost of equity of 14, we are going to have 11.73. Then also the other side, which is for the debt, 201.68 divided by 1241.68 equal, multiplied by 6. So that will give us 0.97. There is no need for us to come and say 1 minus tax again. Don't confuse yourself, because we've already adjusted for tax. All right, that's your working number 1. We've already adjusted for tax. Interest multiplied by 1 minus tax rate. That's why we got this 6.3. And we use that 6.3 to get our cost of redeemable bond to be equal to 6% approximately. And so don't come here again and be putting 1 minus tax. That means you'll be treating tax twice. So when you add the two together, you are going to have a WACC of 12.7. So that's it. This is the way. You can see it's not difficult. Is there anything different from what we have been discussing so far? From day 1 to date, all these things we have discussed it, so it's not difficult, right? So this is what the examiner is asking you to do there. Now let me take you back to the Pathfinder question. I want to show you something, and I'm very sure maybe that's why one of the reasons why some of you are asking me to solve this particular question. Let me go back. Please confirm that you can see that you are seeing my screen for the past question, the Pathfinder question.
It's not up yet, sir.
Okay, maybe I'm still sharing the word. Let me share it. Before that, let me see the subject. Send the messages. Get out. Where is this again? Where is it? I want to show you something. before that. So why are you using year 1 to 3? Thoughts? Zoom user, talk to me. Zoom user, you're asking me why am I using year 1 to 3 since we are given arrears.
Yes,
Are you
sir.
clear
Yes.
now? Or you still have a
No,
doubt?
I'm not. I'm still not clear because I remember there is a question we solved the other time that there was an arrears, and instead of using 1 to 2 years, we used 2 to 3 years. So
It's
here
because
now,
you did not pay attention. You did not pay attention. In the question, right? In the question, I don't know, let me go back to that one. It's a long, let me show you from here. Can you see my Word documents? Zoom user.
I'm seeing.
What's
Yes,
the
I'm seeing the solution.
Are you seeing my Word document, the one we are using for classwork?
Yes,
Or
yes,
I'm
I'm
still
seeing the
showing
solution.
the Pathfinder?
No, I'm seeing the solution
Oh,
now,
okay.
but it's off now.
I was thinking, no worry. Let me reshare. What's your real name, Zoom user? Mopelola, abi? Is it? There's one Zoom user that bears Mopelola.
Yes,
Zoom
I'm
user,
the
are you Mokwe?
Yes, I'm Mopelola.
So look at what the examiner is telling you. I explained it before when I was solving it. This is what I said. You are told in the question that interest is payable annually in arrears
Yeah.
on May 31 and is allowable for tax purposes. Interest is payable 1 year in arrears. But examiner told you if you do otherwise, you are not going to get it right. Examiner has told you that assumed taxation is payable at the end of the year in which taxable profit arise. So examiner wants you to calculate your own, even though tax is payable 1 year in arrears, but examiner has you to assume that tax is payable in the current year. That's why you don't need to adjust for tax. You don't need to do year 2 to 4 here.
Okay, sir. Thank you, sir.
Do you get? You are
Yes, sir.
welcome.
Thank you.
All right. So I want to show you something. That's why I'm sharing the Pathfinder. Now, when you look at the way the examiner solved the question, if you are you will struggle to understand how they arrive at the numbers, because this is what we call wuru wuru. This is what we call wuru wuru to the answer. Because it's not, just do it. And if you are not, if you are not experienced in how to calculate cost of equity, what do you mean by 1 multiplied by 1.04? They ignore they didn't put the formula there. They just do 1 multiplied by 1.04, and then they got the final answer. That's it, and there's 14%. Now, that one is even easier. The cost of bond, how they calculated the cost of bond was something else. So confusing, but in any case, I believe this is one of the reasons why some of you are asking I should solve it. It's not difficult. Just applying the principle. Apply the principle on how to calculate cost of equity, cost of preference share, cost of debt, and then work. Once you understand those concepts, no matter how big is the question, no matter how examiners scatter the question, just follow the procedure line by line. You are going to get to the right answer. Even though I did not follow, you can see in my own solution, this is not the way I solve my own. I don't know, even though examiner has already defined for you that R is equal to our redemption value, redemption year, which is year 3. P is what do they call P? A current market price, So like I mentioned here earlier today, there is no one way of solving a problem. You can use different methods, provided you are doing the right thing. All right. So in their own case, they assume 6% discount rate to calculate their cost of redeemable bond. All right. So I think it's only one rate they just assume. They didn't assume other rate again. And they just say, so try 6%. and they apply that, and they got what they are looking for. So be it, you know. So they must have used a particular there's a way you can do this in between two figures, and that's why they just put 6 here. So it's not explanatory. If you don't have details of all those concepts, if you don't understand those concepts, you are going to struggle with all of this, and you are not going to be happy with yourself that you are not getting it, you know. But in any case, all in all, the market value, the WACC remains the same thing as 12.7. And this is what I'm saying, irrespective of the method you use, provided you are doing the right thing, you arrive at the same answer, because there is no one way of solving a problem. All right. So you can use different methods, whichever one that is more convenient for you. Okay. So that is the question. Now, in the B part of this particular question, okay, in the B part of the question, the examiner is asking you to, you are asked that without further calculation, examiner is not asking you to do calculation. You are to explain the impact of the new bank loan on Felix PLC cost of equity, cost of debt, and then weighted average cost of capital. This is purely theories of gearing, all right? Because in the question, examiner has introduced new finance, additional debt. In the last part of the question before requirements, new finance, you are told that the company has now decided to purchase 3 additional vehicles at a cost of 10 million naira each. That's 30 million. That is 10 million multiplied by 3 vehicles. That's 30 million each. That will be additional debt. The board has decided that the new vehicles will be financed in full by an 8% loan on first January, by an 8% a bank loan on June 1, 2025. So examiner is not asking you to do calculation here. But if examiner is asking you to do calculation, how are you going to calculate? Okay, let me stop sharing this. Let me just show you. Let me just show you. In case you are asked to do calculation on that, how are you going to do it? Right? So let me just copy this. Let me copy this information here. Now, let's say, for example, why not? Don't waste my time. Don't waste my time. Okay, let me share. My Word document was, I think it has a score on its head. I don't know why. Let me just, I've not saved before. Let me just save my work. I'll come back to you later. Yeah, don't waste my time. Okay. Now, go to the end. In this particular, yes, in this particular question, I did not copy it properly. Let me go back. Okay, I was trying to copy this before I want to show you. In case you are asked, in this number B, examiner said no further calculation is required. So just in case, if you asked to, if you want to calculate it, how do you calculate? That's what I was trying to demonstrate for you. What happened to this? Well, I'll come back to you later. Now, this is what I'm just trying to explain here. This is the new finance. This is the new finance, information about the new finance. So let's say in this particular one, you have to calculate cost of debts. You know, the company has borrowed additional loan of 10 million naira each. You're not seeing my, oh, sorry about that.
Yes, you can see it.
I'm sharing now. Now, I believe you can see, right? Can you see it now?
Sir.
So in this part of the question where examiner is telling you that the company has now decided to purchase 3 additional vehicles at a cost of 10 million naira each. So that will be 30 million naira. That is 10 million multiplied by 3 vehicles. That's 30 million. The board has decided that a new vehicle should be financed in full by an 8% bank loan on June 1, 2025. So this relates to bank loan. So how do you calculate the cost? In this case, if examiner wants you to do a new calculation, that means your work is going to change. Your work is going to change. In that case, this is what you are going to do. Let me copy the work I have here. This is what you are going to do. So that means you are going to calculate a new work. In this case, your work will then be equal to, this will be 2 now. This will be 2. Let me add it. Because you have to separate debts. This is the way your formula will look like. All right. So this one will then be multiplied by, okay, this will be multiplied by 1 minus tax. Because we have not done tax on this one before, on the additional loan. All right. So this is the formula that you are going to do. You are going to use. So in this case, it will then be equal to the equity value. We calculated equity value to be 1,040. Yeah. Then debt value is, I think, is it 20? Okay. Yeah, 201. That's 201.68. Here is 201.68. Then, of course, cost of equity is 14%. All right. The cost of the debts, the cost of the bond is 6%. Now, this additional loan of 30 million, the interest rate on the loan, right? The interest rate, the value of the loan is 30 million. So here will be 30. All right. Then remember, we have calculated total market value of equity and debt before to be 1,246. So all you need to do now is to then add additional, your total market value will then change. Total value will now change to, this will then be equal to 1040. Okay. This will be 1040 plus 30. 1040 plus 30. So that will give you 1271. Yeah. Total value will then be equal to 1271.68. I think that is correct. I'm just using head. So in this case, this guy will be 1271.68, right? Then this one too, 1271.68. Again, 1271.68. That's it. However, your after-tax cost of debt, pay attention to what I'm about to say. This particular question relates to non-traded debt. The bank loan is a non-traded debt. There's no way you are going to calculate market value of bank loan. Therefore, you need to go and calculate post-tax interest. So this would be the interest of 8% multiplied by 1 minus tax. So in this case, the X interest price you are going to calculate for the additional loan will be equal to, the interest, this will be post-tax interest. Post-tax interest, okay, will then be equal to the interest of 8% multiplied by 0.7, because tax rate is 30%. All right, so that's what you are going to get. What's this one going to be? I think, is it 5.4 or 5.6? Let me use calculator.
5.6.
5.6. So here will be 5.6. So in this case, my after-tax cost of debt here will be equal to 5.6%. This is how to calculate the cost of non-traded debts by bank loan. So here will be 5.6%. That's what I want to show you, how to calculate cost of bank loan. So just anytime you are asked to calculate, anytime you want to calculate cost of a bank loan, just calculate after-tax interest. Okay, just calculate after-tax or post-tax interest. That's all you need to do. All right. So if that is the case, I will then multiply everything. You know what to do from this stage. You know what to do. This is what the part I want to show you how to do it, so you know what to do to get the final answer. So if examiner asks you to include calculation, but in our own case, you are not asked to include calculation. Examiner did not ask you to include calculation. So let's go back to let me just spend a few minutes on that. Now, this is the explanation. Examiner is asking you, this additional new loan, how is it going to affect cost of equity, cost of debt, and also weighted average cost of capital? This is the way you are supposed to. This is consistent with theories of gearing. Okay, so just go. You already have the material. Just go through the number B and the C part of the question, and then that is that. Okay, so this is where we are going to call it a day. Let me know if you have any question for me so that I can release you. Any question for me? Some of you have disappeared. Yes, Matthew, talk to me.
Sir, this particular material now you share for us, sir. The solution to this past question we did.
Well, of course now. You know where I'm using our normal working notes.
Okay, sir.
Yeah, I'm sure I'm going to share almost immediately. Yeah. Yes, any question for me so that I can release you? And
Sir, this cost of capital, sir, is it possible they make it a mandatory question in FM?
The examiner can use any topic as a compulsory question. So, like I mentioned, cost of capital is foundational to anything you want to do in financial management. So you can't escape it. You can't escape it. If you escape it if it doesn't come as a standalone question, you may see it under cost of under capital budgeting or under weighted average cost of capital. In fact, an examiner can combine cost of capital and capital structure theories of gearing together. So it's not something you can escape. No, particularly for the fact that when you get to professional level, all these things, all these new learnings that you are having, you still do the same thing. So it's better for you to take your time, understand it now, so that when you get to professional, you will not struggle. All right. So any further questions? So I want to release you. So by the grace of God, when next we are meeting, we are going to be discussing project-specific cost of capital. After that, they will move to weighted average cost of capital of the combined activity. We have just one period to go, all right? One period. Okay, so in the absence of no further question, I want to say thank you to every one of you. Kayode is still on with me. He has also disappeared. Yes, Kayode is still here with me. Alimi, let me see. Alimi, Adenuga, Augusta, Biola, Chioma, Felix, Chioma, with Jesse, Chioma Ofo has disappeared. Emeka, Evelyn, Ezine, Ahmed, Ijeoma, Gostand, Joyce, Judith, Lovett, Matthew, Moses, Abiodun, then Amarachel is on, Shibomi is on, Vartor is on, then Mokwe Lola is also on. All right, then of course, I have Omotayo, I have Shola. Thank you everyone for waiting behind. By the grace of God, we are going to meet on Monday when we shall continue with cost of capital. So all things being equal, our next class will be the 6th lecture day on cost of capital. So all things being equal, we finish it on that day if you cooperate with me. And I also hope that my pen will connect to the screen so that my work will be faster. All right. Thank you, everyone. I will see you next time by the grace of God. Good night.
Good
Thank
night,
you,
sir.
sir.
Thank you, sir.
Right, sir.
You're welcome.